Hey everyone, my name's Andy with the Finding Value Finance channel. I've got Scott with me. He's from the Sow and Reap Capital channel. We want to talk about, well, number one, thanks for coming on, Scott. Appreciate it for coming back on. We were chatting a little bit back and forth, and I wanted to capture some of this stuff because I don't know, I think it's cool to listen to. We've been looking at a bunch of different assets, and we know that there's a lot of money creation that's happened over the past few years. We keep coming to the conclusion that we don't know if anything can really necessarily crash massively because there's so much money in the system. There's so much liquidity. And Scott was talking a little bit about, the NASDAQ perhaps going up because of all this liquidity in the system. I'm talking back and forth like, precious metals. I think they're being manipulated. That's my case. I don't see how we could have premiums be as large as they are in silver and gold and platinum, but have the price continue to go down and see shortages of some of these products on the market. Like American Eagles are selling for, $40, 30 something dollars an ounce. How is that possible? It doesn't make sense to me. So, Scott, you were talking about the liquidity in the system. What's your opinion there? Why do you think these assets are going to go up? Like, even if it's a short explanation, what's your opinion?
I think one chart. So we talk about the M2 money supply a lot, but I think in terms of the most readily available cash, we can look at M1 money stock, and this is what happened to M1 money supply. So I don't know. I just feel like there's just so much money in the system right now. And I keep showing you the same chart over and over again, which is the household saving or checkable deposits, right? So I might show it to you again, but there's so much liquidity in the system that I don't know if anything can really crash, because there's just so much money on the sideline. And this is it. Like, I mean, I keep showing you this chart, but like, we've just never seen this level of cash on the sidelines ever before. And this is exactly what M1 money supply is telling you. This is the most readily available form of cash. And like, if you measure this M1 money supply against anything, right? So let's just put it up against NASDAQ, IXIC divided by M1 SL. Like, everything's crashed compared to M1 money supply. Look at this. Yeah, so, I mean, it's absolutely.
So on that chart, what it's showing is that the NASDAQ in relationship to the M2 money supply isn't keeping up. That's what
M1
what Scott's showing. Yep.
Yeah, that's right. Everything's crashed. Like, I mean, if you look at gold against M1 money supply,
and when Scott means crash, he means that the asset valuations against how much money is in the system has crashed. It doesn't mean that the NASDAQ crashed. It means everything has become less valuable. Everything has not accounted for the money supply growth, is what Scott's saying. I just want to make sure everybody understands that.
Yes, that's right. That's exactly right. So M1 SL, this is uranium against M1. Look at that. Like, I mean...
What is that?
This is a log chart. Like, I mean, hold on. Let's just do a fun exercise, and let's just say it catches up to M1 money supply, the valuations against it. So uranium needs to do 35x, 36x.
So
if it was to catch up to the previous ratio. But this is yeah, go ahead, sorry.
This is what I'm going to say. Okay. So the money, basically everything in the system has not accounted for the money supply. When the accounting happens, when this money comes into the system, the market conditions determine where this money goes. And what's happening is right now, the Federal Reserve is screwed, in my opinion, because in a high inflationary environment with increasing interest rates, money's going to rotate into commodities and precious metals, which are really small sectors of global trade, so to speak. They don't account for a lot of the assets. So when this money piles in, the money literally cannot be absorbed by these assets. They're too small under these market conditions. The flow is going to start to flow towards them. The Federal Reserve is going to do absolutely everything in their power to prevent money to flow to those assets. So they're going to manipulate, they're going to control interest rates, they're going to release strategic petroleum reserves, they're going to do absolutely everything to keep the money from flowing into those. Because if the money flows into those assets, you are going to see ridiculous looking consumer price index numbers. They are going to go ballistic. So what's happening here is we could be on the precipice of literally a very highly inflationary paradigm shift. And we can see it in every single chart that Scott and I look at. PPI to CPI, M2 to whatever you want to measure it against, it doesn't matter. This is all aligned for like the largest inflationary period that could be possible. And we are restrained on the growth of some of these energy assets. In coal, we're not expanding coal. Natural gas is going ballistic around the world, and some countries are actively restricting those energy inputs as an act of war. And it could happen further and everything. So they're going to strain the debt in the system, because the design of this system is for a perpetual growth in debt. And if you constrain the energy side, you get this lopsided, we'll call it lopsided inflation, or an expansion of debt and no GDP, accompanying GDP growth, which means the inflation is going to go ridiculous, in my opinion.
I think so.
Yep.
I think so. And that's what M1 money supply is telling you, right? Because M1, as I said, it's like the most liquid form of cash. It's basically like your physical cash and your reserves, basically. So I think this is the money type, the type of money that can actually drive that type of inflation. And it's all caused by, the medical event and government handing out free money. And it went into the direct hands of the consumers, basically, as opposed to like through the banking system, unlike like it did in 2008. So this is really interesting, actually, because this is the first time I've done this. But this is M1 money supply here, the pink line. And then actually, if you look into it, the IXIC, so NASDAQ, did account for the growth in M1 money supply over time since the beginning of the times, which is really interesting. But I don't know if we're going to see a crash, because if we were to actually go repeat history, we did go over this M1 money supply for quite a bit. Like if you look at the 2000 tech bubble, it went way above it. So this is where I would certainly not be investing heavily into NASDAQ stocks, but I don't know if I will call this the absolute top of NASDAQ stocks because of the money supply. But then, as you can see, this is oil here in the blue line. Like, I mean, if you look at the 1970s, where when we had the energy crisis as well, and when we also had that, commodity super cycle, it stayed above it for a long period of time. For like the entire 1970s, it stayed above it and well and truly above it. So just to get back to the M1 money supply, it needs to go up dramatically. Hold on, let me just do a measured move. Let's see if I can do it.
I think what might happen, here's my opinion, I'll interject it. The NASDAQ is going to put in a double top. It's going to come up and do what's called a bull trap. It's going to trap a bunch of bulls as it goes back up, and then it's going to crash massively afterwards. And all that money is going to rotate. Yep, it's going to do exactly that. Yep. And then it's like going to rotate into oil and natural gas and uranium and whatever other commodities there are. It's going to do exactly that.
Yes. And this is basically telling you that oil is cheap. It's actually even cheaper than gold. So it needs to do a lot of catching up. And, we know that uranium is sitting like somewhere down here. So. I don't know. There just seems to be too much liquidity in the system. I just don't think people, because this is unprecedented. Like, I mean, if I was looking, and the only reason why I keep highlighting this is I didn't, up until now, I didn't really pay too much attention on like the cash assets of the commercial banks as well as the households, because they were kind of irrelevant figures. Like in terms of the sheer dollar value, they were kind of irrelevant in the scheme of things, because like who cares about 80 billion sitting in cash account, right? In the deposit accounts. But when it's at 4.3 trillion, 4.5 trillion now, like I think you should care, because this means tens of trillions of dollars in market capitalization of the markets that the money finds itself in. So let's say, like, I mean, it all really depends on the liquidity within the markets. Liquidity in a sense, how actively are the shares or marketable securities traded. But when you're talking about $4.5 trillion in cash on the sideline, that can drive tens of trillions of dollars in market capitalization in the markets it finds itself in. So I think that's hugely important. I think this is becoming increasingly important with the commercial banks' higher level of cash balance as well. I mean, this cash on the sideline, I think, is a real thing. And this changes everything. It changes how much buffer you have before you see delinquencies pick up. It changes the whole dynamic. And I think it means that we're going to have a sustained level of inflation for longer than what everyone expects. Because everyone's saying recession, there's going to be deflation or disinflation. But I just don't think we're going to see that when we've got so much cash on the sidelines. I mean, I don't know. And we've still got supply chain issues. Like if I want to go buy like a vacuum cleaner, for example, right now, like, okay, I ordered a new car, right? So I ordered a new car in April and it was meant to be delivered by August, right? Well, they saying, I got an email last week saying, actually, sorry, your car is still unscheduled for production. You'll have to wait for at least 12 months. And I asked them, can you give me an ETA on the car? And they said, sorry, I can't give it to you. It might be 2 years out. I'm like, what? It was meant to arrive like next month.
What? For 2 years?
So supply chain issues are real. Like, I mean, you're talking about all this money chasing fewer goods and services, right?
Yep.
I don't know. I just don't think.
So like I said, though, the design of the system is to perpetually have more debt. And
yes,
China is literally squeezing the input side. I mean, all that has to happen next for a world power to be brought to its knees is to just cut the oil production. Because then what it does is it transfers all of the money that's in the system into the CPI. So China needs to hold the inputs way down. It basically squeezes back that GDP, and then the system wants to grow because it has to. The system has so much debt. So I and then we see the premiums on physical metals. I'm like, this is ridiculous. This setup is ridiculous. Here's ridiculous. Another thing that Scott had shown me. Scott showed me the surplus of uranium in 1970s. We had a massive surplus in uranium. Now I want everyone to this is what I want everyone to gather from here. All right. I talk about money flows being the most important thing in investing. Money flows and how they are guided into assets. The fundamentals matter, but they did not matter in the 1970s for uranium, which was the largest uranium bull market, had a bunch of surplus of uranium. How is that possible? Right?
Yep. And it all comes down to liquidity in the system and also commodity super cycle overall, right? So yeah, it just catches a bid along with all the commodities. And so this is basically the chart that Andy's talking about. So we had huge uranium surplus production. So this is uranium production in this blue color, field color here. And you've got uranium demand way down here. So back in 1976, when we had that huge run up from somewhere around $5 to $40 per pound, we were sitting on huge uranium production surplus, like huge. This is all the supply surplus that's been building up, and that's also provided for secondary supply from 1990s to now, effectively. And we've pretty much drained all this excess surplus of uranium. So I don't know if uranium could go from $5 to $40 per pound, while we had this huge amount of surplus. Like, how high can it go right now? Like, when we've got huge supply deficits, we've got energy crisis, we're running out of oil, we're running out of natural gas. Everyone's building nuclear reactors, or everyone's restarting nuclear reactors. And remember, we didn't have a lot of nuclear reactors back then. It was a new concept. It was a new technology. Now we're coming up with SMR. We've got all the future production that's going to be counted in from the perspective of investors when they come into the uranium space. It's a whole different game. Like, I think, and Andy was probably the one to say, don't you think $1,000 per pound uranium is possible? When I first spoke to you, Andy, and I was like, don't know. But like, I mean, I think it's a real possibility. I think, actually, I wouldn't say it's a possibility. I think it's probable that we're going to see way over, $500 per pound uranium, or even way higher than that. So I don't know.
Well, here's the thing. This is the the setup that I see. With all the liquidity in the system, what that does is it puts everything in a perpetual shortage. Because you have all these people with a bunch of money, and they're like, I want to buy this, I want to buy this, I want to buy this. So it puts everything in a shortage. If you squeeze your inputs, what's going to happen is it's going to put that much more pressure in the system if you squeeze the inputs like China's doing, or you squeeze your energy inputs. So it puts it in this massive imbalance of way too much cash in relationship to too many physical items in the world. Now, if that squeeze is still there, what happens is you'll get mineral shortages at some point. Like there won't be a surplus of aluminum, steel, and all these other things. So if they want, this is what they've created here. This is the conditions, and I always look at conditions. The governments want to go to a renewable world. The renewable world is massively mineral intense. But if you squeeze the mineral intensity on that side and you hold it on back, what's going to happen is you're going to have to go to solutions that are high energy return to solve your energy crisis problems, because all the money in the system's putting everything in a shortage. And then you want to go with the most energy with least amount of minerals. And everyone's going to, or they're going to turn back on what's existing. So they turn back on what's existing first, which is the coal power plants, which we've seen. Then they're gonna hit natural gas harder than you've ever seen before, because that's what they have available. That's their transition swing producer. Once that runs out, you're gonna see an extension of nuclear power. They're gonna extend those nuclear reactors. Then they're gonna build nuclear reactors, because the solar and wind, they don't have the minerals for it. So you're going to see the largest renaissance of nuclear energy in the history of mankind during the largest energy crisis. Now, here's the thing. They have been underinvesting in oil like nothing else. Oil and natural gas is getting massively underinvested. You're also going to see, in my opinion, a large boom in energy production, because you're going to have to. So if you look at kind of the way that I've positioned, it's energy, energy services, and precious metals, because precious metals is a bet that the currencies could potentially fail. And they could, because if you hold GDP down in a system that must grow with high debt levels, this is, and this is what's weird. This is happening worldwide. This isn't just in America. So what happens if the sentiment of everyone changes all at the same time? And what I mean by sentiment, I'm talking about the sentiment against currencies. If they get scared, if a group of people get scared, what's going to happen is you're going to see a massive shortage of physical metals. And once you start seeing those premiums increase, which we are seeing today, how long will that last? That's my worry. So everyone, if you've been on the channel for a while, you know that I'm a big physical metals holder and I'm a big energy investor. That is the scenario. Money is going to rotate to solve our biggest problems of humankind. The largest opportunities in any market is where you have a solution to a problem. The energy problem's probably the largest problem that I know of in the future. And the most amount of money is going to be made solving the largest amount of problems for humankind. That is how my viewpoint is. And the energy will have negative ramifications on interest rates. It's going to have negative ramifications on regular businesses. So this is going to be, I think, the largest energy boom that we will potentially see of any time. That's my take on it. So when I was throwing out ridiculous numbers of $1,000, $1,600 per pound uranium, I was basing that on the psychological thresholds of previous market booms in relationship to the currency in the system and relationship to the metals prices in the system. What is that going to be priced at if everyone in the world were to get scared from the inflation caused by the energy crisis and then the perpetual money flows going at precious metals? Remember, these energies are indexed to the price of precious metals, of gold. That's why the ratio is so important. And if the energy crisis happens, this will probably ensue. And it just so happens that we've got, a bunch of cash in the system too. So it's not like we've got low cash levels and everyone's running at these precious metals with low cash levels. We've got cash coming out the yin yang, and everyone's going to run at this stuff if the psychological threshold is broken, if the sentiment is broken. Because what that's going to do is the velocity of money is going to just go rocketing. And I don't think people are thinking about this. What they are thinking is this is their paradigm. They think a recession, therefore demand destruction, therefore deflation. That is the current paradigm. What I'm challenging is that paradigm. The challenge is energy is causing the slowdown in the system with unprecedented amounts of cash, which then if the demand destruction doesn't occur because all the cash in the system, and if we have inputs are constrained, it's all going to get transferred into the CPI, which then will be seen by everybody and change the sentiment where velocity could kick up of money flows. That is where I'm scared. I'm scared because this has you could see massive inflation, and this is worldwide. This is everyone running at things with everything they got. That's the scenario. Maybe I'm over the top. I don't know, but that's what scares me. It's not a deflation. It's an everything run of it. Now, another thing I want to talk about is real estate real quick. A lot of people think that real estate's going to crash. In the scenario that I just talked about, real estate's probably going to go vertical, because it's not about people and affordability. It's about how do I maintain my purchasing power? That means if that sentiment changes, if that velocity of money kicks up because people get scared and they start rotating that money, as soon as they get it, they spend it. All of the money in the bond market's going to rotate out. It is literally going to run after anything that has a for sale sign on it that's physical. You're going to see a massive increase in home prices. And I think that's why BlackRock and all these other investment banks are starting to buy now, is because they're front running that move. They're going to front run it. So anything that's a physical appearance or physical that can be sold is going to have a huge premium. Just like Scott was talking about in buying a new car and it's like infinitely delayed. What do you think the value of existing cars are going to do? And I understand that there's problems in the system, and there's probably going to be some lower, people who can't afford things will probably lose some of their stuff. But when that scare happens, money's going to rotate into anything that they can grab. And maybe even the NASDAQ will go up and all that as well. Who knows?
And with the car as well, actually, they said I need to pay another extra $2,000 for the car. So they said, oh, we just had an increase that we can't absorb. You need to pay another $2,000 if you want the delivery of the car.
Are you gonna keep it, or are you gonna say no?
I think so. I think I'm just gonna put the order on, because I think, as you said, I think the second-hand car market's going crazy still, right? So second-hand cars are like valued at a lot higher prices for a lot of the models than new cars. So why not? I'll just keep the order, and if it goes up in price, then I might take delivery and just sell it straight away.
you know, you know what's going to happen? They're going to create a paper market for buying new cars, and then you're going to like be selling the paper. And they're going to
They
start
could.
trading
They could.
like these like
They could.
the right to purchase cars.
Yeah, they could.
Well,
Yeah,
yep.
and what you said around debt is really interesting because everyone talks about the high level of debt, but one thing they don't realize is that we're talking about higher level of debt in public debt as opposed to private debt. So household debts are low compared to 2008, much lower. So if you look at this chart, for example, so you've got the household debt service payment as a percentage of disposable personal income, and it's sitting at a level much lower than Great Recession, right? If you're talking about public debt, it's a different story. So if you're looking at public debt, I'll just quickly type in public debt to GDP. This is the debt that's gone up across the world. It's the government's debt that's got bloated up like this. And at the end of the day, this is inflationary.
Yep.
We're seeing right now the Fed can't reduce their balance sheet, as they said. I mean, I think they were saying that they were going to reduce it by like $60 billion a month or something like that. They haven't been reducing their balance sheet because they can't. They can't. No one wants to buy the treasury bonds.
Yeah, they're
And
screwed.
so they're the ones they've got to buy up.
Yeah, so
So
what?
this is
Go for it.
sorry, go ahead.
Well, I was going to say the federal Reserve and government are screwed because if they don't buy bonds, interest rates are going to skyrocket, and it's gonna cause a scare in the bond market where all money starts to rotate out, and that's the
The
scenario that I've been talking about is when all this money starts to draw out, it's going to buy literally anything that's out there, and
Yep.
it's so much money.
So everything's connecting, right? So Feds basically said we're not going to. They were the biggest buyer of bonds in the last couple of years, and they basically said we're not going to be buying bonds anymore. We're going to let them mature. So what did the Chinese do? They reduced their bond holdings. U.S. Treasuries dropped below 1 trillion for the first time in 12 years, right? So the Chinese are selling down their bonds, and it's all connecting up, right? This is exactly what we're talking about. What are they doing it for? Well, they're gonna have an infrastructure plan.
Well,
So
that's
what they're probably doing, I mean, obviously it's not going to be like a one-to-one direct relationship, but effectively the general movement is that Chinese are selling down US Treasury bonds and they are buying up physical commodities with the proceeds, basically. It's what they're doing. Like they're telling you what they're doing. We just need to sit in these.
so one thing that people I don't think understand is a lot of people say, oh, well, Chinese demand isn't here. That's the wrong statement. They're not looking at this correctly. The Chinese, based off of the market conditions that I describe a lot, the Chinese will buy commodities because they can't buy bonds. That they are selling bonds because they see the same thing that we're seeing, and they're buying commodities because they know that that's a store of value. They can't buy bonds because they're going to lose their butt on bonds. So what they do is the demand is created by the market conditions. The demand isn't created by just having demand. The demand is created by the market conditions because they have nowhere else to put that money. So
Exactly.
why not do an infrastructure project when commodities are cheap and plentiful right now? Load them all up and then do your spending. It's actually quite ingenious. Yep.
And what does that do? That drives up the commodity prices, and then institutional money starts chasing it, and retail money starts chasing it, and that's the flow of money.
That's it. That's literally it.
That's it.
And that's why you need to subscribe to the Finding Value website. And I've got all the good companies that will literally take advantage of all of this. It will literally, that's what Scott and I do. We literally sit around and look for companies that have the most leverage to this commodity bull market. We look at it in every single sector. And I've got some really good picks off Scott. I'm sure he's got some good picks off me. We share our picks and we literally find these companies that I think will do very well. Some of them I think will do incredibly well. Some of them may be duds, who knows? But all we need is a couple. That's
I
this is going
know.
to be massive.
Yeah, I literally out of like, I don't know, I think I've got like maybe 15 core holdings, what I call core holdings, in that I've got sizable positions in like 15 companies. Yeah, even if like 3 hit as big as I think they will, I think that's probably good enough for me.
I know.
Yeah.
So is that
Um,
what else? Do
the
you have anything
market.
else, Scott?
No, I just, yeah, I think this is really unprecedented times. And when we talk about 1970s, for example, and when we had the deflationary pressure, um, the unfortunately the delinquency rate data doesn't go back that far. But one data that does go back that far is the unemployment rate. And I think you could just automatically assume that if the unemployment rate's gone up, then delinquencies went up as well. But if you look at the unemployment rate, and the reason I think we had a big deflationary pressure a couple of times in the 1970s, where the general stock market went down, and energy stocks didn't perform as well as they should have because of the general market selling off, I think it's because of this. So if you look at the 1970s, for example, we've got unemployment rates sitting right here below right now. In the beginning, in the 1971, 1970, up until 1971, mid-year, we had unemployment rate pick up from 3.5% to 6.1%. I think that created, and that was a recipe, I think, that created for that deflationary pressure that we saw. I'll just quickly pull it up. In the 1973. Hold on.
The one thing I will say is that that was the largest real estate market boom in in U.S. history, and it happened during unemployment going up. Because everyone says, "Oh, just wait for unemployment to go up. People can't afford homes." Wrong answer, guys. That's not how it works. It's money rotating out of bonds, finding assets.
Yeah. So there you go. It coincided with the unemployment rate picking up, but we don't have that right now. And until we see the unemployment rate pick up, and until we see, and remember, we've got a lot of buffer in terms of the deposit accounts as well. So we need to see the delinquencies really pick up in order for there to be a threat of deflationary pressure. So I think I think it's, what I'm trying to say overall is, I think we've got market condition that is more inflationary than the 1970s because of all the liquidity that we've just talked about, as well as the low unemployment rate that we haven't seen pick up yet. I mean, it will probably pick up at some point. I don't expect it to stay down here for forever and ever, but we haven't seen it tick up yet. So
I also think that the energy crisis on a worldwide basis is far more intense than it was in the 1970s of just peak oil in the United States. So this is going to be this is crazy. This is probably the best setup I've ever seen of anything in my entire life.
I agree. I agree. Like for a commodities bull market, like this is like nothing we've seen ever before.
Yep. Do you have anything else, Scott? Or
I want to actually just go back and compare like what the nuclear power usage might have been before. So
okay.
this is the site that I go to quite a bit, and I haven't seen this before. Hold on, let me just see. All right. So nuclear power generation. We've talked about the huge surplus in nuclear power, right? So, this is really what I mean by an uptick in demand compared to the 1960s, 1970s. So 1970s nuclear power generation was down here. So let's say 1976. Okay, when the bull market started was, I think, 1973 or something like that. It was sitting at 203.9 terawatt hour, right? In terms of, so 200, remember that number. Right now we're sitting at more than 10 times that amount. And back in 1970s, with 1/10 of generation, nuclear power generation, we had a huge surplus. Yet the price of uranium went from $5 to $40 per pound.
Mm-hmm.
If you tie in supply deficit like we haven't seen ever in the history of uranium, And if we also tie that in with nuclear power generation, which is forecasted to rise dramatically with China coming into play, and Japanese restarts, like, where could uranium go?
It's not on Earth. It's gonna go past the moon all the way to Uranus.
This is crazy.
Uranium.
Like, sometimes
No,
I just look at these data points and just go, this is insane.
Well, so hypothetically speaking, then,
Yeah.
the highest returning possibility in terms of just existing is probably in a junior mining company in uranium somewhere for the largest returns of any commodity of anything. I think it's going to be one of these small little companies that find something that somebody really wants, like a country really wants their asset or something like that.
Yeah.
So, I mean, that will be the largest or the biggest performer, the largest performing commodity stock of all time. That's my opinion. So. Or it's going to be like a precious metal stock or something. If we get a large, a large inflationary scare that happened worldwide, it'd be one of those things. Is my guess, or maybe natural gas. I don't know. It's one of those.
Maybe natural gas. Yeah. Yep. Maybe
those are the highest leveraged areas.
But with uranium, I think you know the analogy around the Hoover Dam through the garden hose. For precious metals, I think it's Doug Casey. But then for uranium, it's like Hoover Dam through drinking straw, right? I think this is where uranium has the advantage in that it's such a small group of companies. So you've only got or I think it's up to maybe 80 companies in total right now. So 80 companies in the world that have uranium mine versus thousands of precious metals companies, for example. I mean, I still love my precious metals, don't get me wrong, but I think uranium has a far better chance of outsizing everything else in terms of gains, just because of how little the number of mining stocks there are, and also how small the market capitalization of all uranium mining stocks combined are right now. So I think uranium probably has the best chance of.
I'm gonna only say one thing that's going to counter Scott's thing there. Yeah. If the scenario where people get scared of debt, then the physical metals will beat everything, because what's going to happen is you can't get your money out of those stocks. There's nothing to transfer into. So people will panic. They'll say inflation's out of control. They've lost control worldwide. And then everyone in the world's going to run at precious metals, and those precious metals will get revalued. But here's the thing. Governments around the world are going to fight that with everything they've got. So it's going to be the largest pressures, opposing pressures in any market that we've ever seen, because you're going to have the free market fighting everything that the governments worldwide are going to do to maintain the purchasing power of their currencies. And you're going to see the biggest fight against both of those things. So in my opinion, I buy physical, I buy the stocks, and hopefully I'm wrong, and we don't have all an outright loss of control of the system.
Yeah. So no, that won't be pretty.
No, it won't.
Yeah. No,
but that's all I've got. That's all I've got, Scott. What about you?
I don't want that scenario to play out.
No, I don't.
Hopefully it will be more subdued than that.
Fingers crossed.
Fingers crossed. Fingers crossed. But I mean, yeah. I mean, we've got a huge amount of inflationary pressure, I think, coming along. I think it was just a fair trade up until now. I think I've talked about multiple times how the major indices could come down to 200 weekly moving average as a key support area, and they've all bounced. I don't know. It looks ready to pop now.
And I'll just say this: you're probably going to see more. You're going to see a larger impact on humans from governments to try to control and slow this down. So you're going to see more lockdowns. You're going to see more viruses. You're going to see more whatever it is, because they have to slow this down. They're going to try to do whatever they can.
Yes,
that's my take.
Agree.
So anything else, Scott? This is a pretty good clip here. If you guys made it to the end here, post in the comments section, say uranium to the moon, and post in the comment section. I'd love to see how many people are going to put uranium to the moon.
Yep.
Any other final
that's
words,
it.
Scott? I'll leave it for you if you want to.
Yeah, John 3:16. I think I shared with you the first time I came on your show, but I think it's fundamentally what the Bible's all about. So it basically says, "For God so loved the world that He gave His only Son, so that whoever believes in Him will not perish but have eternal life." So believe in Jesus Christ, and you will have eternal life in heaven.
All right, guys. That's all we've got. Thank you for viewing. This is Scott from Sow and Reap Capital and Andy from Finding Value Finance. We'll catch you next time.
See you, everyone.